Most people investing in SCHD have no idea what their money actually looks like after 5 years. Not the projections, not the estimates. The real numbers: dividends paid, shares accumulated, total value. Today, Tony breaks it all down across 3 different investment amounts: $1,000, $10,000, and $100,000, and the gap between them will probably surprise you. SCHD, the Schwab U.S. Dividend Equity ETF, is one of the most talked about dividend ETFs out there right now. It holds 100 high-quality U.S. companies that have consistently paid and grown their dividends. We're talking names like Coca-Cola, Verizon, Pfizer, and Lockheed Martin. It currently yields around 3.5% annually, pays quarterly, and has a rock-bottom expense ratio of just 0.06%. But the real story isn't the yield. It's what happens when you let time, dividend reinvestment, and share price appreciation work together over 5 full years. So today, Tony is going to walk you through the exact math, dollar by dollar, for each investment level. Here's the problem most investors run into. They hear about SCHD, they get excited, they throw some money in, and then nothing happens. Or at least, it feels like nothing happens. The dividends seem small. The price moves slowly, and after a few months, they start wondering if it's even worth it. That's because most people are looking at SCHD the wrong way. They're looking at what it pays today instead of what it builds over time. A 3.5% yield sounds boring. But once you understand how dividend reinvestment stacks on top of price growth over 5 years, the picture changes completely. Let's start with the smallest amount, $1,000, and work our way up. Starting with $1,000 might feel like you're barely making a dent. And honestly, at first, that's kind of true. But let's look at the actual numbers. Based on SCHD's historical performance over the past 5 years, which includes both the 2022 downturn and the recovery, a $1,000 investment with dividends reinvested would have grown to approximately $1,460. That's a total return of around 46%. Now, the dividend side of this. In year 1, your $1,000 position generates roughly $35 in dividends. That's about $8 to $9 per quarter. Sounds tiny. But here's what changes the math. SCHD has grown its dividend per share by an average of about 12% per year over the past decade. So by year 3, your dividend payments start to climb noticeably. By year 5, you're collecting closer to $55 to $60 annually, and that's before accounting for the additional shares you picked up through reinvestment. Every quarter when SCHD pays out, those dividends buy you more shares. More shares means more dividends next quarter. It's slow, but it's real. And here's something most people miss. Because SCHD reinvests at whatever the current price is, market dips actually help you. When prices drop, your dividends buy more shares at a discount. So the 2022 correction, which scared a lot of investors, actually accelerated the compound growth for people who stayed in and reinvested. After 5 years, that $1,000 has turned into roughly $1,460 in total value. You've collected approximately $195 in total dividends along the way. Not life-changing money on its own, but the foundation is there. Now let's move to $10,000. This is where SCHD starts to feel like a real income engine. Using the same historical 5-year window, a $10,000 investment in SCHD with full dividend reinvestment would have grown to approximately $14,600. Same 46% total return, but now we're talking about an extra $4,600 on your money. The income side is where it gets interesting. In year 1, your $10,000 position generates around $350 in dividends. That's roughly $87 per quarter. Not enough to retire on, but enough to notice. Over 5 years, thanks to dividend reinvestment and SCHD's consistent dividend growth, your total dividend income collected is approximately $1,950. Almost $2,000 in cash returned to you, all of which was automatically put back to work buying more shares. By the end of year 5, those reinvested dividends have added roughly 15 to 20 additional shares to your position, depending on the price at the time of each quarterly purchase. And those extra shares keep paying you more going forward. What's also important here is the stability factor. SCHD's portfolio is built around companies with strong free cash flow and long dividend histories. During the 2022 bear market, while growth stocks were getting cut in half, SCHD held up significantly better. It dropped, yes, but its dividend kept growing even as the price fell. That's a key feature of dividend investing that gets overlooked. The income doesn't stop just because the market has a rough year. After 5 years, your $10,000 has compounded to roughly $14,600. You've pocketed nearly $2,000 in reinvested dividends along the way, and your quarterly income is now meaningfully higher than when you started. Now let's go to $100,000. This is where the numbers stop being theoretical and start changing how you think about money. With the same historical 5-year return, a $100,000 investment in SCHD with dividends reinvested grows to approximately $146,000. That's a gain of $46,000 on a single investment, without adding a single dollar beyond your opening position. But let's talk about the income, because this is where SCHD really shines its scale. In year 1 alone, your $100,000 generates roughly $3,500 in dividends, about $875 per quarter. That's already paying for a car payment, utility bills, or a solid grocery budget every single month, essentially for free. Over the full 5-year window, your total dividends collected and reinvested come out to approximately $19,500. Nearly $20,000 in income returned to you, all automatically reinvested back into more SCHD shares. And because of SCHD's consistent dividend growth averaging around 12% annually, by year 5, your quarterly dividend payment has climbed from roughly $875 to somewhere closer to $1,200 to $1,300 per quarter. That means your annualized income at the 5-year mark is now closer to $5,000, a 43% increase in income from the same original investment, just from natural dividend growth and reinvestment. That's the compounding effect that most people talk about, but very few people actually sit down and calculate. If you're listening there, comment with your favorite season. I'll like everyone who does it. Here's the part that Tony wants you to really think about. When you compare all 3 amounts side by side, something becomes very clear. The percentage return is basically the same for all 3, around 46% over 5 years. But the dollar impact is wildly different. The $1,000 investor gained about $460. The $10,000 investor gained about $4,600. The $100,000 investor gained about $46,000. The math is linear, but the life impact is not. $460 is nice. $4,600 starts to matter. $46,000 changes your options. And here's the thing nobody talks about. SCHD isn't trying to make you rich overnight. It's trying to make sure that every single year you own a little more of 100 solid American companies, and those companies are paying you more than they paid you the year before. The yield on cost, meaning the dividend income as a percentage of your original investment, keeps climbing over time. For someone who put in $10,000 5 years ago, they're now collecting dividends at an effective rate closer to 5% on their original money, even though SCHD's stated yield is still around 3.5%. That gap keeps widening every year. That's the real power of dividend growth investing. The yield you get 5 or 10 years from now on money you invest today will be significantly higher than what the fund advertises right now. And that assumes you never add another dollar. So let's bring this all together. Over 5 years, SCHD delivered roughly 46% in total returns with dividends reinvested. A $1,000 investment grew to about $1,460 with $195 in total dividends collected. A $10,000 investment grew to about $14,600 with nearly $2,000 in total dividends collected. A $100,000 investment grew to about $146,000 with nearly $20,000 in total dividends collected. And in all 3 cases, the dividend income itself kept growing year over year, not because Tony did anything, but because the companies inside SCHD kept raising their payouts. SCHD is not a get-rich-quick play. It's a get-wealthy-slowly play. And for most people, that's actually the one that works. The patience required is the price you pay. The compounding is the reward. If you want to see how SCHD stacks up against other dividend ETFs over the same 5-year window, that video is right here. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depends on your own decisions and actions.